Welcome to EVNTAlpha, where I cover economic news and data, the S&P 500, and stock trading signals with captivating historical performances. With the S&P at a crucial technical spot for its current rally, the next 2 weeks are one of the most pinnacle times in its history. With a soft PPI report, S&P futures rallied amidst another dovish shift in sentiment, seeing rate hike expectations come down even further. With geopolitical controversy continuing to escalate, will this bullish PPI and CPI report this week be enough to continue the bull run going, or are we in for another grueling pullback? PPI came out below expectations this morning, sending S&P futures up in pre-market. The news was fairly good as because our month-over-month number came in lower than expectations and actually saw a decline. This confirms for us that inflation is truly cooling off in the short term rather than the case of companies taking the hit due to inability to raise prices further. This sent rate hike expectations down even further to 10.2% from 16% yesterday. So we have had quite the dovish shift in the past week off that good CPI and PPI reports we received this week. Despite the dip we saw after market open, the S&P traded back up off its lower support zone to trading back up above the open leading into the close. Now, this dip we saw today could have something to do with the Iran escalations, along with some news that came out claiming Warsh was not happy with the inflation report, hinting to us even with the beat in expectations, Warsh still feels uncomfortable with where numbers are, and to not be too excited as we still have hurdles to get through before we're in the clear, which we'll talk about a bit later. Coming up tomorrow, we have retail sales as well as initial and continuing jobless claims. We want to see retail sales to print above consensus and forecasts, as this will imply we still have strong consumer confidence, hence a strong economy, as a byproduct of that is consumers with disposable income to drive sales further. If we get the opposite, it would hint that consumer confidence is low, as when consumers feel the economy is doing bad, they tend to spend less and prioritize saving for a rainy day. As for initial and continuing jobless claims, data suggests that the labor market is improving as payroll growth has remained positive and initial jobless claims have remained somewhat contained. This can give us a preemptive update and hint as to how our payroll report might come out in the coming weeks. Ultimately, if inflation continues to show signs of cooling off and the labor market and economy remain resilient, that is a fairly bullish outcome amongst the situation going on. Now, as for the Iran conflict, we have now seen a fifth straight day in exchanges of strikes between the U.S. and Iran, showing no signs of de-escalating. The New York Times reported that the United States attacked new Iranian military sites today, which the Pentagon said targeted Iran's ability to threaten vessels in the Strait, like we saw the past few days. This followed Iranian attacks on American military facilities in the region. The U.S. has reimposed the naval blockade on Iranian ports as of now. As a result, oil has risen for the third day in a row back to above $80 a barrel. If we continue to see oil rise, this will pose more and more of a problem for our inflation risks, as it will likely lead back to a hawkish shift in the Fed. This is likely one of the largest points that convince half of the Fed committee that rate hikes are appropriate, as the global economy runs on oil. The more expensive oil is, the more expensive many other goods will be as a byproduct. So despite the 2 days of somewhat good news, it is important to remain cautious, as it's still unknown how much of a shock to inflation oil rising again will cause amidst this re-escalation. Now let's jump a little bit into some S&P price action. Yesterday we talked about prices closing back above our 78.6 retracement, which meant we were likely to see a retest of our pivot high at 75.78 labeled as B. This is because now we are holding our yellow zone as support, a very pivotal area that traders tend to like to use to understand where prices are going to go. So now that we are back above the 78.6 retracement, our main focus is now, do we finally break above our pivot high at B? As this would validate the ABCD pattern we've been talking about, which would bring our upward targets to 76.45 and 77.53 at the 1.236 and 1.618 retracements of our B to C move. Another major resistance, if we do break B, will be our all-time high at 76.20. Should we break out, keep an eye out on how we react to all-time highs as well, as it's very possible we see a rejection there and a reversal back down to lower support levels. Taking a look at S&P futures on a shorter time frame, if we start closing back above 76.16.5, it's likely we go on to fill this unfilled gap that occurred on the 12th. If we start trading through this upper resistance zone at 76.24 and 76.26, that brings our next target to 76.40 and 76.50 at all-time highs. Now let's talk a little bit about SpaceX. SpaceX traded below its IPO price today. However, it did not close below it. If we start seeing closes below IPO price, look out for these lower targets at 131.55, 120.42, and 102.43, as these are major retracements of the initial rally that are often reached, and many IPOs tend to play out this way. As when locked up shares become available to sell, it drives further volatility and often further sell-offs. So it wouldn't be crazy to see SpaceX at some of these lower prices as well. Should we reach the zone between 1.382 and 1.618, look out for major block trades and volume, as this could indicate institutions are ready to put their money back into SpaceX. A few days ago, we talked about a trigger on Apple. Go back to that video if you want to see further detail around what hinted at this recent move we saw. We finally got that green line breakout above our all-time high, where you realize an all-time high, have a few months of consolidation, and then go on to break past your all-time high, indicating the rally is likely to go on much further. We smashed our first target of our ABCD pattern we've been talking about, similar to the setup with the S&P currently. We broke past our B point, which implies we reach 1.236 to 1.618 retracements of the B to C move. If we see prices break past 327.82, meaning close above, it's likely we reach the second target at 344.23. Now, as for a little update on GM, we have started seeing it bounce off the bottom of our triangle pattern that is developing here, as well as bouncing off our 200-day moving average. If we continue to see prices close above this consolidation here, around $78 a share, ultimately that likely means we're going to go on to retest the top of our triangle again. Go back a few videos where we talked about a trigger on GM, which achieved about a 33.5% return on average, leading into December 15th roughly. So if we continue to break outside the consolidation, look out for that retest around 84 to our resistance zone between 88 and roughly 85. If we do break through this major resistance zone, we are likely to see continued momentum upwards and potentially reaching that average return based off our historical triggers. So let's talk a little bit about Baker Hughes, or ticker BKR. This is a stock we also talked about a couple days ago. Go back to that video if you want to see more details around this trigger we got on BKR that hinted that we might see this move upwards. Now, we've reached our first target, which was that pivot low of this trend line we broke to the downside. We rejected off of it, but notice, we're holding the 200-day MAN support and had a fairly large rejection wick that bought back up today. So hinting, it's fairly likely we do see some further upward momentum in which we attempt to break this resistance and go on to our second resistance target. Should we start seeing trading back below the 200-day MA, maybe we're going to go on to retest that trend line again and retest the support zone down here. Another stock we talked about over the past couple of days was Exxon, in which we also got a pretty significant trigger, about 24.6% on average, leading into December 17th of this year. Now, one of the biggest focuses we highlighted was the 200-day MA. We wanted to see a bounce off the 200-day MA and to go on to retest the neckline of our head and shoulders pattern. We did, in fact, smash that target of our head and shoulders pattern neckline. And now from here, we came back down to reject it. But again, similarly, we saw a big rejection wick. This is generally a good sign that you're going to go on to attempt to break it and see further upwards momentum. If we do go on to test our trend line, We really want to see, do we start trading through it, or do we start rejecting back down and back below the neckline? As remember, any trend line break, that often implies you go to retest the pivot highs that were created along the way, making it far more likely we see that potential 24.6 on average, like historical triggers suggested. Now, looking at AMP, AMP continued to trade further upwards today, fully filling the gap that we experienced back in early January of this year. Now that we've continued to break through it, it's fairly likely we do go on to see one of the next pivot highs that were developed along our trend line break, right? We had our trend line break back in early July, signaling we were likely to see some upwards momentum up to these pivot highs. I think it's fairly likely we do go on to see 548, 549-ish, and if we do start closing it back above this resistance, that puts into play re-seeing our top target of our trend line, as well as roughly the 15% on average we saw from historical triggers and the trigger we talked about. If you're curious, you can go back. It was like the previous video or the video before that. But ultimately, if you want more detail around this setup, I go a bit more in depth in terms of what you want to look out for. So another stock we talked about in the past couple of days was ADI. The trigger we got suggested we get an average return of about 21% leading into January 4th of next year. One of the big things we talked about was this major support trend line we've been developing. Right, here's our first two contact points. We went on to test it a third time, in which we are seeing a bounce and some consolidation builds. A really good hint to see if we are going to get some upper momentum is if we do break this resistance zone. You can see I labeled it as confirmation break zone. So if you start seeing closes above this consolidation we're seeing just over the past roughly 3 weeks, that could be a really good sign that we're going to go on to test this upper resistance zone around 436 to 445. And if we do break that 21% average looks that much more likely. But generally speaking, this structure we are holding our trend line of support. Notice the major rejection wick as well. You're seeing a very big theme of stocks getting bought up today after that dip that we saw, about an hour to hour and a half out from the open. So from here, we're going to want to start seeing the price try and trade back up and get through this resistance zone, as then it's fairly likely we see that upside potential. The last update I want to provide you is CF. CF, we were talking about this bullish bull flag break that occurred a couple days ago, where you have a fairly steep incline and then a parallel channel that descends down. Whenever you go on to break the upper trend line, it implies you're going to go on to see the pivot highs that were developed along the way. We did, in fact, alongside many stocks, see a sell-off today and went on to retest the top of our trend line. And also notice the major rejection wick in which it was bought up second half of the day. We did not close back above, or actually we did. We closed back above the close of our resistance zone here. Right, so this is suggesting not only with the upper momentum, but the close back above, it implies we go on to retest this next resistance. If we do break, you can see I have it labeled confirmation break. If we do break back above, this pivot high, it's fairly likely we do go on to continue to try and test this resistance zone between 128 and roughly 130.5. And again, if you break that one, the next resistance target is going to be around 136.50 to 142, and ultimately if we get above that, it's fairly likely we see that 23% average off that trigger we talked about it yesterday. If you want more information around it in this setup, go ahead and revert back to that video as I go a bit more in depth as to how I got this 23% on average. So the only new trigger I want to talk about today is Meta, which it experienced a bullish ATR cross. What you're viewing here is called Trender, which uses a measurement of volatility called ATR to form bands around the price. whenever you see crosses above or below the bands, it suggests you've had a severe shift in the environment, and price is likely to continue to go in the direction of the break. So as you can see in the chart, whenever you have green shading, that means you're in a bullish environment, and red shading vice versa. Now, we've seen 9 historical bullish crosses, which finished out its full 120-day evaluation period, in which the price rose on average 38% over the next 119 trading days, or just about 6 months. When looking relative to its sector, it outperformed about 20.5% on average, and relative to the S&P, it performed about 24% on average. Now, across those 9 historical triggers, the price was higher about 89% of the time, and it's currently performing at 11.7 profit factor, meaning its average wins are about 11 to 12 times larger than its losses on average. We got a 10th, 11th, and 12th trigger recently, one in January, one in April, and one just this past, one just today, July 15th. And so as you can see, the past 2 were fairly unsuccessful, which we had some fake outs. However, in this third one, we experienced what's called a triangle breakout, which we'll jump into a bit further just in a second. But essentially here what you're viewing is that average return lined up with the price. So this is what it would look like if it achieved just in line with the average. And then on the downside, right, this is about 2 standard deviations out from the average, essentially showing you your predictive power or your typical dispersion from the average, right? So typically prices, or just about 96% of prices, fell between these 2 bands based off historical reactions. Taking a look at Meta's reactions to those trender signals, on the x-axis we have trading days out from the signal, and on the y-axis we have cumulative percent change. So in other words, what you're viewing here is what your returns would be if you had bought Meta on each one of the buy dates and then held for 120 trading days, or again, just about 6 months. Now, the blue line is the average return across all your historical triggers that have finished out the full 120-day period, right? So that's not including the 2 most recent in January and April alongside the one we experienced today. So excluding the 3 yellow active ones, right, our blue average leads up to that 38% on the 119th day. Notice our 2 triggers back in January and April are performing somewhat in line with the mid returns currently. Ultimately, with this third trigger, I'm a bit more optimistic this time around, and we'll get into it a little bit further in the next chart. So if Meta were to achieve that roughly 38% on average, that would bring it to about $942 a share, leading into January 5th of next year. Now, the reason why I'm a bit more optimistic of this trigger this time around than the past 2 that occurred on, these fake out peaks is we just experienced a triangle breakout. And generally speaking, as you've seen me mention before, whenever you do have these triangle breakouts, it implies you're going to go on to test the pivot highs that were created along the way. As you can see, we are currently testing the first pivot high created in the triangle. If we do continue to trade upwards past it and close above, let's just say 691, that makes it very likely we're going to go on to retest our next resistance zone at about 744 to roughly about 760. As notice, there's not much structure as of recent in between these 2 zones, one being a humongous gap that we filled later on and starkly rejected back down. So what you're going to want to look out for is, do we reject off this current resistance zone and start trading back below? If we, trade back below the 200-day MA, that could be a good sign. It's not ready to go yet. But what you may see if it does reject is some structure build before it goes on to break above later. So don't be super terrified of a rejection here if it does happen, as that would be fairly normal. In any case, if we do go on to break this resistance zone between roughly 742 and 760. That makes it fairly likely we go on to retest all-time highs. And at that point, if we break our all-time high, as I've said many times in previous videos, that would constitute as a fairly bullish break, as that's going to be the most bullish a stock can be. Nobody is in the red once you break past all-time highs. So if that happens, that 38% average becomes that much more likely. So that's everything for today. I hope you enjoyed the video. If you did, please give it a like and subscribe, and I hope to see you in the next one.